I'm joined by Stephen Marks, Managing Director with Fitch Ratings.
So, Stephen, let's start off with you talking a little bit about REIT development. What kind of trends are you seeing there?
The way we think about development is we look at cost to complete relative to gross asset value. And because we don't look at total CIP or total development, because we view some of that as sunk costs. So we're looking at the risk of a company on a go-forward basis in terms of liquidity and access to capital. And so when we look at that ratio, it's actually gone down. It's now roughly around 2.5% as of 9/30. That's down from the mid threes from a couple years ago. Somewhat surprising to us. We would have thought with the growth in the economy that there would have been a little bit more perhaps risk-taking or more development activity, but in fact we've seen just the opposite. Multifamily companies have dialed down development. Healthcare REITs have never really developed much. Retail is about the same. The one place where we've seen it pick up is actually in office. A lot of that is build to suit, so the pure spec building that we saw perhaps heading into the previous crisis is not the case today. So we view generally that development risk is pretty well boxed and under control.
And what kind of trends are you seeing for REITs with bank borrowing?
Right, because companies do use their bank lines to fund development and other activities. The one interesting thing that we've been looking at really for the last year or two is just looking at overall bank lending or bank borrowing exposure. So we look at how much has been drawn on the line plus term loans, and we compare that to a company's overall debt stack. And what we've seen is that ratio has increased from about 19%, call it 20%, 5 years ago, to now it's about 25, 26%. So what that tells us is issuers are accessing bank capital more than they have in the past, which is a little bit surprising to us because we would have thought that given, you think about the last 5 years, unsecured bond market has been great the last 5 years. If there were ever a time where companies would have close to zero on the line and zero term loans because they funded everything in the unsecured bond market, it would be now. But in fact, it's really just the opposite. Bank exposures have increased. And we understand why companies like to access a lower form of capital. Term loans are much cheaper, a much more in some ways much more flexible source of unsecured capital for companies relative to say a 10-year. But we are a little surprised, and it's not something that's a real issue for us yet, but it's something that we're watching more closely because it could become an issue as companies become more tapped out in terms of their dry powder on their access with their bank relationships. If there are liquidity concerns, they may have one less place to turn.
And that unsecured bond market, what is that doing to REIT liquidity?
It's actually improving it. And one of the interesting trends that we've seen in the last couple of years has been the emergence of the private placement market. That market has not been a huge source of capital for unsecured debt capital for REITs a couple of years ago, but it is very much now. Now REITs comprise roughly 15-20% of the private placement market, which is a huge increase from basically zero from a couple years ago. And we understand why companies are doing it. It's a great form of capital. You can issue unsecured in small increments. You don't need to do a $250 million or $300 million large size public offering. You can do smaller increments. You can do 7-year, 10-year, 12-year maturities. You can do delayed draws. It's a very flexible form of capital. And for us, we don't really differentiate when we think about unsecured debt capital. We don't really differentiate between the public markets and the private placement markets. We view them in some ways as quite equal, and we see and we understand why companies are accessing the private market more so than the public market.
And lastly, Stephen, 2017 is almost here. What are you going to be watching?
In many ways, it always starts with liquidity and access to capital. Because REITs are so capital intensive and they can't retain capital, they need consistent access to capital and where are the various pools from which they can access. So it's always going to be something that we're keeping an eye on. We generally view the unsecured bond markets as still a very strong source of capital. We view the equity markets to the extent that companies want to raise equity for an acquisition or perhaps to delever as fairly available as well. Depends, of course, on NAV premiums and discounts, but it is a good source of capital for companies. So that's certainly one thing. Fundamentals we generally expect are going to be fairly solid generally throughout the sector. So we're looking at fundamentals. We're also looking, as always, we have to focus on development. It is a big risk for companies, although, as I mentioned before, it's fairly well under control. So those are probably the three main things that we're keeping our eyes on right now.
Well, thank you so much for your time, Stephen.
Yep, thank you, Alan.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.